What's going on, traders? My name is Chris, and in this video I'm going to show you guys how to optimize your rate of returns trading US T-bills on Interactive Brokers. In this video I'm going to do 4 things. Build an awareness about trading US T-bills and give you a couple of ideas about how you can implement them into your investment strategies. Number 2, I'm going to show you how to optimize your rate of returns investing in T-bills using a little bit of code. Although this is not a coding video, I will post the code that I used to do these calculations online so that you can track what I did afterwards, just for informational purposes. But again, I'm going to do everything for you in the video. The third thing I will demonstrate in this video is how you can get a 1 to 2% loan or line of credit on the value of your US Treasury bill positions in Interactive Brokers. And then the last thing I'll do is show you how to buy T-bills on Trader Workstation, which is very simple, but I'll add it in just in case anybody really wants to know. But there's already videos that show how to do that. This video is not a recommendation to trade or invest in any specific product. It's only for informational purposes. I believe that when it comes to discovering market opportunities and market inefficiencies, it requires work and research. What I think is that you guys who are watching this are in for a really good deal because you get to profit, number 1, from the work and research that I do. And number 2, I give it to you guys free here on this channel because I have the ability to monetize my channel. And so it makes it worth it for me to make this content for you. So if you really appreciate the work that I do, click on the first link down below and check out Interactive Brokers. That's all you have to do to support this content. Really appreciate it. Let's get on with the content right now. Lately, there's been a lot of info about US T-bills popping up on the internet. There's a lot of videos. A basic explanation of what a T-bill is: it's a fixed income product. It's basically government debt. So you're giving a loan to the government when you buy these treasury bills, and then you hold it until its maturity date. And on the maturity date, you receive a payment, which is the full value of that bond, or of the bill in this case. So normally these bills, they have a face value of $1,000. So when you buy the T-bills, you pay a discount for it. So you might pay $900 for it, and then you get $1,000 back at the end. So for example, if you look at my trading screen here, these are T-bills expiring from 57 days to 83 days out from the current day that I'm recording this. And you can see currently they're yielding about 5.3%. That's why I think it's important to build an awareness about T-bills, because it's sort of a fundamental product that every investor should understand when it comes to measuring your opportunity cost. If you think you can make more elsewhere, you'll probably do that. If you think you can't, or if you have short-term cash that's waiting around the sidelines doing nothing, then you may want to consider T-bills as a short-term opportunity. So there's a few pros and cons when it comes to trading T-bills on Interactive Brokers. One of the cons is that you actually have to pay a trading fee to get into a position. You have to pay a commission. And the reason for that is because you're trading with a broker. Now, you can trade on the primary market, which would be TreasuryDirect.gov, actually going directly to the auction and then bidding on these T-bills yourself when the government issues them out. The problem with that is that, to my knowledge, it's only available to US citizens. If you're a foreigner and you want to invest in US T-bills, which is considered a safe fixed income investment, then you probably have to do it through your broker. How do you determine what's the best maturity to invest in? Well, there's a few variables you need to understand, and I'm going to be using some C code to help me show you this, demonstrate it. First thing is, your principal amount of capital needs to be high enough to dilute the trading fee that you pay on Interactive Brokers. Now, the trading fee, they say it here on their site, is 0.2 basis points for the first USD 1 million. Typically, it's about $5 USD to $7.50 USD per trade. That's what I've noticed. So you have the current interest rate of what this bill is yielding. You have your principal starting amount. You have the trading fee. And you have how many times in the year you want to reinvest. So the last variable is basically how long to duration your T-bills are. So I'm going to compare a T-bill investment to a 1-year GIC that you would get at your Canadian bank, for example. So here at our banks in Canada, the banks sometimes they offer us a thing called a GIC, which is the same thing as a CD. Basically, you lock up your money with the bank for typically a year or less, and you get paid a fixed interest rate on that. Now, the downfall with that, of course, is that there's a lot of opportunity cost. One of the main benefits with trading T-bills and Interactive Brokers is that your cash is liquid and you can use the value of your T-bills as collateral to trade other assets or to pull out a withdrawal out of your account for, most of the value of your T-bills. So I'm going to compare the rate of return of a GIC to what you would get trading T-bills. But remember, they're 2 different types of investments. And then once I'm done comparing them, I'm going to show you how to optimize your rate of return to determine the best maturity date for T-bills. Let's get on with it right now. So I'm going to run this. And you will see the first example here is that the investor is only paid when their 1-year GIC reaches maturity, which is pretty common with Canadian banks. You lock up your money with the bank and they pay you a rate of return. Let's say the current rate of return is 5.3% and your principal capital amount is $12,000. I'm going to change this in the next examples. With this investment amount and interest rate, we would earn $1.74 per day. It's always good to know how much you earn per day. And assuming a trading fee of $0, it typically doesn't cost anything to invest in a GIC except your opportunity cost. The total profit would be $636 and the return on investment was 5.3%. So what I'll do is go ahead and bring in example number 2 and run that. So example 2 is the investor earns the same rate of return as example 1, but is able to reinvest their earnings on a more frequent basis. So what I wanted to do with this is demonstrate to you some of the impacts of compounding. And how I can describe compounding is basically when your investment reaches maturity, you then go ahead and reinvest your new principal capital into another investment of the same type, hopefully with the same interest rate or a higher interest rate if they've gone up. And you'd be reinvesting with a higher principal capital, so you'd be earning more because you're investing more. And over time, if you continue to do that, your blended rate of return ends up being higher than the basic rate of return that you would get on your 1-year GIC because you're getting paid more frequently and you're investing more frequently. So example number 2 subtracts a USD 7.5 trading fee every time a reinvestment occurs. That's something to keep in mind. It's already baked into the calculation. And again, the principal capital is still $12,000. The interest rate is 5.3, and I set it to have 6 reinvests in the 1-year period. The next thing is you can see that we've run into an error, which is saying the investment amount is too small or there have been too many reinvests because our profit after every reinvest is not reaching $1,000. The reason this has to be included here is because, like I said earlier, for this type of investment, it doesn't make sense to reinvest your capital into another T-bill until you've actually generated enough of a return to buy another T-bill. Now, I'm not accounting for the fact that you might just deposit more money into your trading account. I'm only accounting for the returns that you get from the T-bill itself, from the investment itself. So what we need to do here is we need to either increase our principal capital amount to an amount that will generate us more interest, or we need to reduce the number of reinvests in the 1-year period so that we earn more interest before reinvesting again. So I'll go over into the source code and I will go to the marker for reinvests and I will lower this number to 2. So 2 reinvests in the same year. And let's see if that changes it. And you can see that our investment amount is still too small or there's too many reinvests. So basically the investment amount is too small. So I'll show you what happens if we change the principal capital amount. Let's try 50,000 as the principal capital. So we would be buying 50 bonds essentially, or 50 bills. Number of reinvests 2 times per year. And you can see now it actually worked. And I have a little bit of a breakdown showing you how much is earned after every reinvest. The interest rate's 5.3%. There will be 2 reinvests in the 1-year period. After 183 days, the total profit is $1,321. So after the maturity of our T-bill, that's how much we're earning. Actually, what we really want to find out here is what's the optimal principal capital amount and number of reinvests per year that's going to yield us approximately $1,000 when our bill expires. And obviously this is a dynamically changing number because the interest rates are always changing. Of course, you could sell the T-bill before it reaches maturity, but you would have to account for another trading fee in order to go ahead and sell that into their market. There's another little function in my code here that does a quick calculation for how many days it takes to earn $1,000 plus the trading fee. So the minimum holding period to earn $1,000 is 139 days. So with a $50,000 investment amount, you'd be aiming for T-bills 139 days out so that you can ensure you make $1,000. So the next time you reinvest, you can buy another T-bill. What I'll do now is go over to the principal capital amount. And of course, if I raise this, it's going to take less days to get to $1,000. So again, hence my thesis, which is the rich get richer. The more you're investing, the more that you can reinvest, and therefore the more you can compound your money faster. When I raise the principal capital amount to $100,000, now it only takes us 69 days to earn $1,000 plus the trading fee. So if you had $100,000 to invest in T-bills, you could buy T-bills with about a 69 days to maturity, or maybe a little bit more. And that would be enough to make you $1,000 upon the maturity of the T-bills. And then your T-bills mature, you go ahead and reinvest the funds into the market, okay? So what I pretty much concluded to you guys here is that it's not worth investing in T-bills with a small principal capital amount and that the higher your principal capital amount is, the more you can benefit from the effects of compounding, which is definitely what you want to do in my opinion. The last thing I want to show is how you can achieve a higher blended rate of return. It's not much higher, but it does make a difference. So principal is 100,000. Now, since after 183 days, the total profit is 2649. The reason it says 183 days is because I set it to have 2 reinvests per year. So let's say I raise this number to 4 reinvests per year. And you can see we're still valid here. And we've actually increased our blended rate of return to 5.33% from 5.3%, which is really not much more. It's not even a percent more. Now, obviously, you want to do more reinvests, as many reinvests as possible. Now, the thing is, the more reinvests you do, meaning the more treasury bills you buy and the shorter dated treasury bills you buy, the more principal capital you need in order to make enough to buy another T-bill every time you reinvest. So a $100,000 investment is not enough with 6 T-bill reinvests per year. So assuming T-bills of 60 days to expiry. And our study is already telling us here that the optimal amount is 69 days. I lowered the reinvest to 5 and now we're back in the ballpark here, okay? So one of the real big benefits, in my opinion, of using Interactive Brokers to trade T-bills is that when you buy these T-bills, you can essentially trade on their value at any time. You have to have a margin account, and you can use the capabilities of your margin account to invest into other assets or to pull cash out of your account and use it to do other things. So that's what you're seeing here. My CAD cash is negative and I'm invested in 8,000 worth of UST bills. So this is an example of I'm using the margin capabilities of my account. This is a bit of a high risk profile. If it was a stock portfolio, right, you can see the maintenance margin is only about $400 away from the net liquidity in this case. But because I'm invested in bonds, this is not a high risk profile, which is fine. So actually what's going on here is that I'm earning a rate of return from these positions and I am paying to have this negative Canadian cash balance. So basically what I'm doing is I'm taking a low percent or an optimized percent loan out of my trading account right now. So I'm paying whatever the interest rate is for this, which is I think 6.4 to 6.8%, and I'm earning about 5.3% on these positions. So together it would be about a 1 to 2% loan that I'm taking out of my account. So I'll go over to the code and I'll comment out example 4. Example 4 just gives the example of buying 50,000 worth of T-bills, earning a rate of return of 5.3. Now the investor withdraws 49,000 in cash out of their account, of course using the margin capabilities of their account. The investor is paying 6.83% on year on the negative balance, and essentially the blended rate of return for what the investor has to pay for their currency, accounting for what they're earning on the T-bills as well, is about 1.5%. So that's how you pay 1.5% to loan money out of your trading account, by investing into T-bills at the same time. All right, guys, let's move on. In Interactive Brokers, it's very easy to trade T-bills, but the way I do it is so simple. You can either open up their global bond scanner by going up to new window and then scanners and then bond scanner. And you'll get this window right here that looks like this. And then I go to the top left, I select US Treasuries. On the top right, I select T-bills only. And then I just hit search. And you can sort by maturity, near, far, or far near, either one. And then you can go ahead and click on the maturity column to sort by maturity. And you can see the rate of return for each one of these T-bills, the current bid and offer prices, the change on the day, the face value, and you can add any other columns here. If you don't see the column you like, you can right click here on the column, go to customize layout, and then find the column for bonds, and then the items should all be there. Now you can add them directly to your watch list by clicking and dragging here and bringing it directly into the watch list. That's one way that I like to do it. The other way is, of course, you can go straight into your watch list, click on an empty space in the watch list and type in US-T, press the enter key, and then you'll get this, click on government bonds, and then you get this window that pops up. Yeah, so at the top you select bills, and then under the maturity date, select your range of bonds that you want. So let's say it's those. And then you can just click on add and it'll add all of them to your watch list. So that's a pretty easy, convenient way to do that as well. Okay. When it comes to trading the bonds, guys, a lot of people on YouTube just show you, buying it at the ask. But, there's a bid and an offer price for these bonds, just like there are for stocks. So if you want it to be patient, you could essentially just join the bid and get a better price. Remember, you're buying these on a secondary exchange, which is Interactive Brokers market here that they're making. So, you can put in your own bid. You don't necessarily have to pay the offering price. The spreads are quite tight, so if the maturity of the bond is very far out, that spread you're going to pay is really negligible. It's not really going to make much of a difference. So that's something to note. If it's shorter dated maturities, you may want to compete a little bit for the rate, but it's up to you. If you enjoyed this video, let me know. Check out this playlist full of Interactive Brokers videos. They're some of the best on YouTube right there. And check out this video. It might not be out yet, but it's basically the #1 guide for how to use margin with Interactive Brokers on YouTube. Thank you for watching. See you in the next one.